So let's say the candlestick opens at a price, the market moves up, the market moves down, and then closes at a certain level. And then the next candlestick opens at this price, and the market moves up, moves down, and closes. The part where there was no trading activity is what is known as a gap. So what are the reasons that there can be a gap? One, the stock market opens below or above previous candles movement. So this is a time issue. If something bad happened overnight with the markets and all the markets crashed in the Asian markets or the Australian markets, and then the South African market opens the next day, it has a higher chance at opening because of the futures at a way lower price than what it closed at. So that is one reason for a gap. The second reason is that there can be major buying or selling volume with one market. So if there is a certain price that the market's trading at, and then there is a huge seller at another price, and they are willing to sell at a certain price lower than what it was trading at before, there is a good chance that the market will gap. And this is sometimes due to manipulation, or that there is volume being transferred from banks to banks or billionaires to billionaires. So that's another reason. The other reason for a gap would be if there is no liquidity. If there is not a lot of trading activity, and you would see this with penny stocks, go to any penny stock there is on the JSE market and go look at maybe a majority of penny cryptos, what I call them, or penny stocks, and go look, and you'll see that there is very little liquidity, which means that there is not much buying and selling activity taking place, which is causing those gaps in the market. And you need a lot of liquidity and a lot of volume in order to make up for those gaps.